Have you ever heard that saying about, when global bond yields are kind of going crazy, it's like prime time for carry trades?
Yeah, that's a pretty common idea you hear floating around.
The concept's easy enough to grasp, right? Borrow money where the interest rates are super low and park it somewhere else with much higher rates. Boom, profit.
Sounds simple.
But there's got to be more to it. Like, what's really behind those carry trade returns?
Exactly. Like, what are the real forces driving that profitability?
So today we're going to really dive into this whole connection between global neutral interest rates and the kind of returns you can expect from those currency carry trades.
Really get to the bottom of it all. And for this deep dive, we're looking at a really cool academic study that just came out. It's called Twin Stars, Neutral Rates, and Currency Risk Premia by Furu, Fontaine, and Crone. They take that common idea, about bond yield gaps and carry trades, and they basically build this super solid theoretical and empirical foundation under it.
So like more than just a rule of thumb.
Way more. It's not just about, oh, if yields are different, do this. It explains the why and actually puts numbers to the whole thing. So our goal today is to make sure everyone listening walks away with a much deeper understanding of why those global neutral rates actually matter for carry trades. And hopefully, help you guys get a more sophisticated view of these market dynamics.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So I bet some of you listening have heard, right, that when global bond yields are all over the place, like really spread out, it's a signal to jump into these carry trades.
Yeah, it makes sense on the surface, doesn't it?
Right. One country's offering way higher interest rates on their bonds than another. Seems like, well, free money almost.
Seems like a pretty straightforward way to make some cash, yeah.
But what's cool about this study, I think, is they go way deeper. Like they actually explain and give proof for why this might be true, but also like when it might not work that way. That's where things get really interesting.
Yeah, and their main finding, it's actually pretty eye-opening. What they found is that on average, when global neutral rates are lower, you tend to see lower returns from those carry trade strategies.
Makes sense.
But flip it around, higher average global neutral rates usually mean better carry trade returns. So it's not just about what the bond yields look like at this very second. It's tied to the overall level of these long-term interest rate, how do you say it, like benchmarks, those neutral rates.
Okay, so we keep saying global neutral rates, but some people might still be wondering, like, what are we actually talking about? What are they, and how did this study figure them out?
Great question. What's really smart about this study is how they calculate those rates. They use this bilateral bond market model. They look at all the major G9 economies.
All the big players.
Exactly. And bilateral means they're not just looking at each country's bond market like it's on its own little island. They're really focused on how those markets are connected to each other, like how capital flows between them, especially related to the U.S. bond market.
So like a web, basically. All these markets linked together.
Exactly. And through that lens, they've spotted some big trends globally. There's been this downward trend in these neutral rates across the world for a long time, although we did see things switch up around 2020. They also found that interest rate trends in these countries tend to move together, kind of like they're dancing in sync, and the U.S. neutral rate is like the lead dancer.
The U.S. is setting the pace.
Yeah, pretty much. And get this, they also noticed that the gap, the difference between these interest rate trends across countries, it's actually been shrinking over time.
Huh. So those trends are becoming more similar. That's kind of a big deal, right? Especially since at the beginning we talked about how big differences in bond yields were supposed to be good for carry trades.
Yeah, it definitely adds another layer of complexity.
So how do those long-term interest rate trends actually affect the profitability of a carry trade? What's the theory behind it all?
Okay, so here's where the heart of their theory comes in. The study shows that when you look at the difference between these long-term interest rate trends in two different countries, that difference basically is the risk premium you should expect from a carry trade using their long-term bonds. Think of it this way. If one country always seems to have a higher trend in its neutral rate compared to another, That means there's always going to be a difference in how much they're expected to return over the long haul. And that's exactly what a carry trade tries to take advantage of.
So those trends aren't just something to watch, they can actually tell you something about future returns.
Precisely. The research actually shows that this difference in trends can help predict what'll happen with returns from holding foreign bonds, specifically when you measure them in US dollars. And what's even cooler is that the further out you look, like with longer-term bonds, the more powerful those predictions get. Those long-term trends become even more important when you're thinking about longer-term investments.
That's a really important detail because a lot of times you hear carry trades are all about short-term interest rate differences.
Exactly. And while those short-term differences, and even the shape of the yield curve, can give you some hints, this study argues that those long-term trends, the ones that are kind of simmering under the surface, they give you a much better, more complete understanding of those risk premiums that come with carry trades. It's about those long-term differences in expected returns.
Okay, so that's the theory. But did they actually find proof for this in the real world? Did their research back up this whole connection between neutral rate trends and carry trade profits?
They did. They looked at tons of data. They compared the average interest rate spreads between those G9 currencies with the actual returns people got from doing carry trades with those currencies. And what they saw was a super strong match. Like, for example, they saw average excess returns from holding different currencies range from something like 3.1% annually for the Japanese yen all the way down to, get this, negative 2.1% for the New Zealand dollar.
Wow, that's a pretty big swing.
Right. And when they looked at the average 3-month interest rate differences for that same period, they saw a really similar range, from negative 2.58% for the yen to 2.14% for the kiwi.
So the numbers line up pretty well with what their theory said should happen.
Yeah, the numbers really do back up their theory. And they actually included a figure in the paper, figure 8, which is a really great visual representation of this relationship playing out in the real world.
Oh, I remember that figure.
Yeah, it shows how the returns from different carry trades added up over time. And the really cool part is you can see how those times when the average interest rate differences were big, like especially from around 1995 up to the 2008 financial crisis, those were the same times when the returns from those carry trades just skyrocketed. It's really clear. Those big average yield differences meant huge profits from carry trades.
So basically, that figure is like a picture of their theory in action.
Exactly.
Okay, so we've covered a lot about big, developed economies. What about those smaller, more globally connected countries? The study talked about them too, right?
They did, and this is a crucial point for anyone trying to figure out neutral rates. They said that when you're dealing with those smaller economies, the ones that are super plugged into the world's financial system, you got to be extra careful about calculating those neutral rates.
Why is that?
Well, their currencies and economies are much more sensitive to things like global capital flows and interest rate differences. So if you just use a model that only looks at what's going on inside that country, you might miss the bigger picture of what their long-term neutral rate really is. You got to remember that the whole global currency market plays a huge role here. The global market is like a giant transmission system connecting everything.
So, for everyone listening, the main takeaway here is this. If you want to understand what's really driving potential profits from carry trades, don't just look at the yield differences you see right now.
Right, look beyond those surface numbers.
You need to think about those global neutral rates and, even more importantly, how those rates are trending over the long term. The theory suggests that those trends are directly connected to how much you can expect to make from those risk premiums in the currency markets.
Exactly. So next time you hear about central banks changing policies or see those long-term interest rate expectations shifting, think about what those changes could mean for carry trades.
It's not just about whether rates are going up or down right now.
Right. There's more to the story. What other big economic forces, besides those short-term rates, do you think we should keep an eye on to gauge how carry trades might do in the future? That's a good question for you all to think about. And if you're really interested in digging into the nitty-gritty of the data and all the fancy techniques they used in this research, I definitely recommend checking out the full paper. It's Twin Stars, Neutral Rates and Currency Risk Premia by Furu, Fontaine, and Crone.
It's a fascinating read.
Yeah, it really is.
Well, on that note, we'll wrap up for today. Thanks for joining us on this deep dive.
See you next time.